So when people cite this memo as proof that the trust structure is illegal, the memo itself tells you that it cannot make that determination. Hello, I am Andrew Gilba, strategic partner with Atlas Law Partners, and we specialize in advanced trust structures, complex trust administration, and tax law under Subchapter J of the Internal Revenue Code. Brief disclaimer, what you're about to hear is educational content only. This video is not legal advice and not tax advice. It cannot be relied upon for your personal situation unless you are formally engaged with Atlas Law or your own qualified legal and tax counsel. That said, this is not surface level explanations, so grab some caffeine because today we're going to walk through one of the most misunderstood trust tax issues in the United States. The IRS recently released an internal memorandum commonly cited to claim that complex non-grantor trusts don't work. We're going to go do three things. We're going to read the memo exactly as written. We're going to compare it against what the Internal Revenue Code actually says. And we're going to explain how fiduciary accounting law fits into the picture because tax law does not operate in a vacuum. We're going to do this calmly, precisely, and without the theatrics. This is not a marketing video. This is not a loophole video, and this is not a trust hack video. This is a technical explanation of the IRC Chief Counsel Memorandum AM2023-00006, which discusses a marketed trust structure and claims that promoters misunderstand IRC 643. Spoiler alert, they do. Let's kick this off by reading the first line of the memorandum. This memorandum may not be used or cited as precedent. Interesting. It's very important to say this. This memo is not law. It is not precedent, and it is not binding on courts. It is definitely not binding on taxpayers. Even the IRS says it themselves. My job today is not to argue emotionally. It's simply to ask, does the memo accurately state what the law does and does not do? Let's also look at what the memo explicitly admits because this matters. The IRS states in writing that it did not review specific taxpayer documents and it did not analyze any specific trust instruments. It did not examine fiduciary conduct. And it did not analyze non-grantor trust rules. It assumes, purely for discussion, that the trusts were otherwise valid. That means this memo is abstract, general, and fact agnostic. That's not a criticism, that's a limitation. So when people cite this memo as proof that the trust structure is illegal, the memo itself tells you that it cannot make that determination. The core claim of this memorandum is that Section 643 defines distributable net income, not taxable income. Therefore, allocating items to corpus in and of itself does not eliminate taxation. That statement by itself is not wrong. And this is where a lot of bad arguments typically fall apart because the problem is not what the IRS said here. The problem is what the IRS assumes after that point. So let's kind of dive into how Subchapter J actually works and understanding overall the structure because this is the key concept most people miss. Trust taxation is a derivative, meaning the trust does not start with taxable income. As a matter of fact, it just starts with gross receipts. What I've done is I've actually worked with our accounting team and legal team to build an entire flowchart here so you can follow along with exactly how the money flows inside of advanced trust structures such as this one. When we look at it, it starts with gross receipts. You'll see here at the top of the screen. This is cash flow actually received into the trust, whether it be rent, royalties, capital gains, extraordinary business distributions, asset sale proceeds. Those are all gross receipts. Here's the critical legal point. Gross receipts are not income. Neither tax law nor trust law treats every dollar received as income. And this is not opinion, this is black letter law. There's no clear determination of whether this is taxable income, fiduciary income, or any other aspect of income except for gross receipts. Then we go to the second point here, fiduciary accounting, right? Fiduciary accounting is interesting because it comes first, right? And this is all based off of the UPIA regulations. So before the IRS even gets involved, fiduciary law intervenes. So IRC 643B says, for the purpose of subparts A, B, C, and D, the term income means the amount of income of the estate or trust for the taxable year determined under the terms of the governing instrument and applicable local law. In plain English, the Internal Revenue Code does not define trust income, trust law does. So applicable local law is typically the Uniform Principal and Income Act, or UPIA for short, adopted in some forms by nearly every state. This is not optional, this is not aggressive, and this is not statutory sequencing. So here's the history of corpus and why it actually exists, because the next step is whether it goes to fiduciary accounting income or principal or corpus. So this is where we need to slow down and understand what corpus is and what the original intent of corpus was. So here's the history behind it. Corpus dates back centuries in English trust law. Its purpose was simple: to protect long-term wealth, preserve capital for remaining beneficiaries, prevent short-term beneficiaries from consuming the estate. That distinction, income versus principal, existed long before the Internal Revenue Code existed. Tax code inherits this framework. It does not replace it. So let's talk about the UPIA authority. Under the Uniform Principal and Income Act, trustees are explicitly authorized to allocate receipts. So let's dive into UPIA 401. A trustee shall allocate receipts and disbursements to income or principal in accordance with the terms of the trust and to the extent the trust does not provide in accordance with this act. Translation: the trustee decides within legal confines what is perceived to be principal and corpus and what is seen as income. Let's look at UPIA 404 and 405. This is the capital gains concept. Money or property received from the sale, exchange, liquidation, or change in form of principal asset is allocated to principal. Plain English, capital gains default to corpus, not income. This is not tax strategy. This is fiduciary accounting law. This is why most people, including the IRS memorandum, skip corpus. If the IRS wants to tax something differently, it must first defeat the governing instrument or defeat the state fiduciary law or prove abusive, sham, or lack of good faith. The memo does none of these things. So the memo assumes capital gains is equal to taxable income without first defeating corpus allocation under fiduciary law. That's a sequential error. You cannot tax something as income before establishing that that income under the law is defined as income. Does that make sense? Extraordinary dividends, the same error. The memo makes a similar argument with extraordinary dividends. It claims that 643A Part 4 only applies to simple trusts. Therefore, a complex trust must always treat them as taxable income. But 643B, totally different subsection, independently states that extraordinary dividends allocated to corpus are not income when done in good faith under governing law. So the IRS memorandum conflates two things: whether income flows through DNI versus whether it's income in the first place. These are not the same question. DNI controls who gets taxed. Fiduciary accounting controls what exists to be taxed. DNI is a secondary calculation. If you look at distributable net income, DNI, you'll see that DNI is calculated after fiduciary accounting income. So DNI is really just a formula. It's fiduciary accounting income minus fiduciary deductions. DNI answers only one question: how much income can be carried out to beneficiaries? It does not answer what is income. It does not answer what is corpus. It does not answer what is taxable in the first place. And that is the core error in this IRS memorandum. Taxation happens last, not first. Only after all of this do we ask, was DNI distributed or retained? If distributed, then as you can see, the beneficiaries pay the tax. It's distributed to the beneficiary as a K1. If it's retained, then the trust pays tax on DNI at the second highest tax rate in the tax code. So why does this structure even exist in the first place? This is not accidental. Congress intentionally designed Subchapter J to respect state trust law, to prevent double taxation, and to preserve fiduciary discretion. Congress could have said, all capital gains are always taxable to the trust, regardless of allocation. It didn't. The IRS does not get to rewrite that by an internal memorandum. So what are we not going to cover today? Very intentionally, we're not covering grantor trust rules under 671 through 679, sham trust doctrine, bad facts or abusive promoters, or even substance over form cases. Those are real issues and they deserve their own videos. Non-grantor status in particular is commonly misunderstood, and we'll address that separately. Today was about one narrow question. Does this IRS memorandum invalidate fiduciary corpus allocations under 643? The answer is no. This memorandum was not and is not malicious. It is not stupid and is by no means meaningless, but it is incomplete. It tells you what 643 does not do without analyzing fiduciary law and what it can do. And tax law cannot function without fiduciary law in the trust context. Courts decide law, statutes control outcomes, and memorandums guide internal enforcement, nothing more. So if you're using this type of trust, facts matter, documents matter, fiduciary behavior, it matters. There's a clear line between lawful planning and abuse. Understanding that line requires more than just reading a memo. It requires understanding how trust law and tax law actually interact. Thank you guys for watching. I hope this kind of connected the dots and helped add some more clarity to this memorandum and maybe help you understand that this memorandum was not the whole point, the whole conversation. Thank you guys. I appreciate your time. If you need anything else, feel free to reach out to Atlas Law. We'd be more than happy to help you with any sort of setup or understanding of this exact structure.